So, welcome to the Real Estate Life podcast. So, on this podcast, we are dedicated to creating a life of passive income through real estate and doing something that we love along the way. Today on the show, we have Ismael Reyes. He has been an active investor in the residential space since 2005. And in 2016, he started focusing heavily into the multifamily. He owns and manages 599 units throughout different states. He's in Alabama, Florida, Georgia, and Tennessee. Love all the states that you're in. And he also has written a book that's called The Bottom Line Up from about passively investing in multifamily properties. Now, Ismael also comes from a military background. He was a lieutenant in the U.S. Army for 28 years. And Ismael, I want to thank you for your service also. And we're going to elaborate on that because that's a very interesting background, how you went from the military and now you're a full-time multifamily investor. A lot to talk about, man. Welcome to the show.
Thanks, Abiel. Thanks for having me, man. I'm excited.
So I know that prior to we got onto this recording, we talked about how you discovered this business in 2005. And tell me how did you discover it and what is it that attracted you to this business?
Yeah, no, I tell you, I'm the kid whose favorite game is Monopoly, right? I don't know why. I mean, it's just one of those things I was kind of born with, and of course that's one's a game, but if you sort of translate that and kind of go into real life with that, there's a lot of lessons to be learned. There's other games that are very good. The cash flow game is very good, and it teaches us about how to get out of these mindsets that you can't do certain things. And so for me, it was something I always wanted to do. It was one of my passions. My other passion, obviously, like you mentioned, was the military. I retired, after 28 years as a lieutenant colonel. And, it's just been great. I had to make a decision. And I'd served my country for a long time. And I had this other thing that I really wanted to get at. And I'd started as a single family guy, like you mentioned, but I really, really want to turn it on and do it as a full-time, way forward, jumping out of the military and into that. So that's kind of where I'm at.
When you got into the single family space, did you go in as a broker or you just went straight into investing into single family?
Straight into investing. So like it happens to a lot of folks, not just military, but in my case, that's kind of how we get, a lot of people get started. You become an accidental landlord because you get moved somewhere and you have an option of living on post, or you have an option of renting off post or buying off post. And the military actually gives you what's called a basic allowance for housing. It's basically money for you to pay rent or buy. And so a lot of people want to just rent, but you're paying somebody else's future when you rent. And so what we did is we bought in a lot of the places that we lived in, wherever we could. And then when you get moved after 2 to 3 years, you have a decision to make. Some people sell. Some people can't sell, then they're stuck because now that property is doing something there and they're not with it, et cetera. So that's kind of how I got started early on. But it became more purposeful the more I went. When I started in 2005, I was actually already looking at investment properties, certainly not, 100-unit properties, but, I was looking at duplexes, triplexes, trying to build from there, like a lot of people do.
Now, in the military, in the culture where you were there in 28 years, did you have mentors in the military that would advise you on how to invest in real estate? Is that something that it's in your industry or not really?
That's a great question. I didn't know of anyone. I mean, I didn't know of anyone, but as I started digging in, there are some very good Facebook groups. I run a Facebook group for veterans. There's another partner that I work with. Or I say a colleague, because we haven't partnered on any specific deal yet, but Eric Upchurch has another program. It's called ADPI, Active Duty Passive Income. And there are others like that where you can really latch on if you're looking for it. But it's not something that, that is very prevalent. I'm trying to actually break into that a little bit more and get the word out. And that was part of why I wrote that book, because I think people get stuck in a single family, small time mindset when there's just so much more value when you jump into multifamily, and it can be done. You don't have to be rich. This allows the average person to get into a deal, partner with 3 or 4 other people, and really get after something. And you know that better than I can. that I do.
Yeah, no, I agree with you 100%. And you know, not to say that I would change anything from my past of what I went through the residential space, because the lessons and the tools that I learned there is one of the reasons I have my successes in multifamilies. I picked up a lot of tricks in the trade, bumped my head a lot of times in that business, and learned a lot about rehabs, because ultimately an apartment interior renovations are very similar to a single family renovation. It just might be a smaller space. So you do pick up some things along the way. Now, it's really interesting that you discovered a niche because you saw the opportunity in the military culture where a lot of your colleagues weren't getting the education to invest in real estate the right way. And that's where you found the opportunity to put this book to. Is this book more directed to the military, or is it for anyone out there to read?
It is a book that is that can be read by anyone, not just the military. But the book itself, initial target was, you know, really focusing on the military. And when you look at that term bluff, that doesn't mean a lot to people unless you're in the military. In the military, that's one of the first acronyms you learn, because that's when you're dealing with leadership. You know, whatever your superior officer or superior NCO, you have X amount of time to provide them an update. And so a lot of times they just want the bottom line. Give me a summary. And then if I want details, I'll get you details. And that's what this book is. This isn't everything you need to know about real estate and how to do multifamily syndications. It's kind of an outline of how you can do it. And if you want to dig in deep, there are other books. And I encourage people to call me and get a hold of me and to really dig in on some topics. And we do.
So so you basically, this is straight to the point. I'm not here to give you too many stories. This is what exactly you need to do. This is where you need to go and find your research and learn it. I like that. I like that because, I mean, some of these real estate books are they're massive. And so there is a lot of fluff or bluff, whatever you're going to call it, but there is. I agree with you on that. Now, what made you take that leap from single family space, and you had that aha moment? Man, I need to jump into multifamilies. When did this happen? What deal did it to you that you were like, I'm over it?
Yeah, I think we were overseas. I think we were in Mexico at the time. This is about 2000. I want to say 2010. That's kind of when I first this isn't going to work. You were overseas. My family, we're working out of the embassy there. By the way, if you haven't gone to Mexico City, you got to go. It's not like
it's an incredible city,
like the border. It's just a whole different place.
And
but we were getting called.
Culinary experiences I've had, like one of the best culinary experiences I've had.
Oh yes. No, I encourage people. I mean, yeah, you got to be careful where you're at, but if you've got some, some people there, or at least you go through a tour guide, they'll keep you out of places where you shouldn't be. But
beautiful city.
And anyway, we were there, and we started getting calls, from a property manager about a property that we had, one of our properties, and the tenant was giving them trouble. Tenant was trying to get out of the deal, so we're working through that, and I'm providing the landlord some guidance about how to go through that. First of all, we're getting calls really late. I'm like, Jesus, this is why I have a landlord. That's the first thing I was thinking. But, so we're getting calls, and I'm trying to juggle work and this, that, and the other. And I'm like, this isn't right. So finally, what really threw me over is the property manager actually quit. So it wasn't even difficult.
It's all hands
it was
on
something
deck.
silly, but they just didn't want to deal with it. I mean, and they did, and they quit. And so now my wife is not happy with me. She's having to basically do some, overseas landlording. We're having to juggle, our jobs and everything else going on. And I'm dealing with host nation, country, military, and doing exercises. I don't have time for that. But here we are stressing with that. I'm like, there's got to be a better way to do this. I mean, this is ridiculous. And a lot of people think that, hey, I'll just hire a property manager and all my problems are solved. Well, guess what? That property manager doesn't always have your best interest in mind. They don't care about your bottom line. That's not that they worry about.
You got to manage the manager.
Yeah. I think that's when it just clicked. I was like, there's got to be a better way.
Yeah. And what was your first acquisition in the multifamily space?
So I was a passive investor on a couple of deals, a portfolio deal. It was around 2017. I'd started looking at, the multifamily space and syndications right around 2016, but it took me a little bit to kind of get my head around it and the timing to be right. I was just about to go overseas. And I decided, okay, if I'm going to continue to invest, because at that time I had my single family, but I was actually also lending money. I had a partner that I did basically hard money loans for fix and flippers. So we had that thing going on. I had my single family stuff going on. And then I was like, okay, this is maybe a good opportunity because I'm about to go overseas again. And the last time I was overseas, it wasn't a good experience trying to manage all this madness. So so I went overseas. I was in El Salvador for 2 years. And right about the time that I got there, I already had an idea of what I was going to do and who I was going to work with. And we closed on something. And so those 2 passive deals were really my first. And for me, it wasn't so much that I was afraid of the multifamily space. It's just that I wanted to understand some of the inside, kind of behind the curtain. And those passive investments gave me an opportunity to sort of buy into a network and sort of start working my way around in there and figuring out the terminology and everything else.
So you went into a syndication deal first as a passive investor.
Yes.
How was your experience again?
I mean, it was good. I mean, so I tell people all the time when I talk to them, is like, there's 2 ways you can do this. One, a syndicator and you like that, you trust that individual, you like them, and you're going to go wherever they take you. Here's a deal and wherever. Okay, I trust you. You tell me it's a good deal. Great. I wanted to do it a little bit different because my end goal was to be on the active side. So I couldn't just take somebody's word no matter how good it was. I wanted to understand why. So I picked my locations. First and foremost, I have my criteria, just like if you're doing a single family, a little bit different on how you kind of approach it. And obviously underwriting, there's some nuances, but ultimately you pick your location before you start looking at properties. And once I had those areas in mind where I was comfortable investing in, then I started looking for operators, syndicators that were working in that space. And once I got someone that I trusted, that I was able to see what they were doing and I had a good feeling about and had a chance to talk to and vet, we were able to get on a deal because I already knew that area in general terms, right? I wasn't there. I didn't get a chance to scout it, but I had the kind of the lay of the land.
The location. So for you, first, foremost, the location was the most important thing. So
yes.
Because was that a Florida deal?
This was not. This was actually a Memphis deal.
Memphis.
Great
market.
Memphis. Yep.
I love Memphis.
Yeah.
We just purchased a property 45 minutes north of Memphis. Love that market. We'd like to continue investing there. It's like I wouldn't say it's a secret anymore, but there's a lot of traffic going into Memphis, a lot of money going in there. Okay, so you went through the syndication route, but you had your specific criteria. I like that you said that you kind of screened the operator, because the operator or a syndicator is really crucial to the performance of your property. I always say that you can have an amazing property, but if your operator is not good, they could ruin that property. So it's really important, and that's hard sometimes. It's hard to interview if you're not in the business and trust an operator, if you're not getting a reference or someone's recommending you or giving you some great experience that they've had with that operator. So that's how you got in, and then you learned the steps and the process through that operator. I guess he gave you some guidance. When you invested with him, did you tell him up front, I want to learn as
absolutely.
And he was okay with that.
That was it. I said, listen, I got money.
That's the only way.
But this is my end goal. And I just, I'm going to be that investor who's going to be asking questions. Not everybody wants to deal with those investors, right? They want a high net worth person that doesn't ask any questions and just, they're getting their checks, and that's great. But I was very upfront that this is my goal. And he had that personality where like me, come here, man. We'll work together. I'd love to, talk to you about it. And, and he was giving me something. And you can buy into a network by, getting into different, there's these programs that you can get in. It's like a mentorship program, and they're formal and there's a cost. Or there's the way that I did it, where you buy into an investment with the right operator that can give you some of that same stuff. And, oh, by the way, you get a little bit of return on top of that.
Yeah, so you're getting a lesson and making money back.
Yep.
So, I like that approach. I get called a lot from investors to go through the process that way. And we've actually done that. I've done that in the past in my career. And in the beginning, they're very edgy and they're asking a lot of questions. As the deal starts flowing, it starts becoming easier. They start understanding it. And in fact, some of these investors, I seen them grow and do their own thing. And I seen some of them saying, like, you know what, I want to go into a smaller space, those big apartments. We want to be more hands-on, a smaller project. So it evolves, which is the beauty of this business. Yeah. Now, Ismael, I want to talk about this deal that you got in Augusta, Georgia, 104 units. Mind you, I've been dying to buy a deal there. I've gone outbid it a few times. I think I might even put an offer on this deal. I don't remember, but I'm glad you got this deal. It's a great city you invested in. Second largest city in Georgia. I love the demographics. I love the economic growth that it has. It's actually a cool town. I've been to it a few times. I love the vibe. I love the energy of that city. So tell me about this 104 deal. How did you discover it? How did this deal land in front of you?
Yeah, no, that's great. So part of this business is about who you partner with. And like I said, I bought into a network. Well, part of what I was doing is working with people that were hitting the ground, that had, essentially what we call boots on the ground presence in the cities. And that they can go in and be that second eye to manage the property manager, as we talked about. And so they brought up a deal and say, hey, this looks interesting. It was and simply when you start working these places for a while, you get a good idea of a price per unit and what is in the realm of good versus, that sounds a little bit pricey to me, without even really going into any of the details. You just kind of know. And that one was one where the numbers, you just had to tell me what it was going for about a unit. And it was like, okay, let's look at that one. There's something there.
So what was the price you paid for this property?
It was 5.7. I think we were about 55 a unit.
And what was your average rents going into the deal?
We were just under $600. Oh. All classic. No, I mean, that's the thing too, that, you get into some of these deals and, there's barely any bone left. They call it a value add deal, but everything's been value added.
I mean, I know you're in Broward, right?
I'm actually in Orlando.
You're in Orlando. I mean, the numbers that we see here is like, it's 150 a door and the rents are 1,300. It's complete opposite. So I get, now I see what you saw the opportunity. And what value, how much bump up of rents you knew you could get by doing what type of value add? I want the listeners to know through your eyes, when you saw these classic units, what you identified with your team. Guys, this is what we need to do. This is what we need to add to get what rent. Yeah, no, and it's a great question. It's that simple. That's the thing about this business that sometimes I explain to people. It's not rocket science, man. That's one of the things I love about it. Sometimes it's just simple things and just having the money and having the discipline to execute your game plan. So what is it that you saw that you said, we can execute this, we're going to hit this rent, it's a home run? Yeah, I think the biggest thing that we saw was, there's a couple of ways to add value to a value add. The easiest is when your market rents are much higher than your current rents. This is not like, hey, I fixed something, therefore I'm going to raise the price. This is like somebody hasn't been paying attention, or really, in a lot of cases, the owners have had these for so long that they're already making money. They're not already making. They don't, that $100 is like, that's a lot of work. Why am I going to go for that? When you get these things and you can bump rents, this is the first thing, bump rents 150 a door for just pure classic. I'm not doing anything else. You were able to do that. That's what we were able to do. And in fact, when we underwrote this, we were thinking that we were going to hit, our year 3 rents is about how long it was going to take to get us. It's like year two, 2.5. It was going to take us that long to get to where we are now. We've had that property. We haven't even had it 6 months. And we're already at our figures for the end of year 2 for rents. And that's just for the classic units. And so what we did in this case, I mentioned that this property was all classic. Well, what our plan was to do a small sample and renovate 20 of those by 1/5. And then you have self-comping for another person that can come in and go, hey, listen, you don't have to work so hard to figure out what the rents are. Here they are right here in my T12. They're right there. And so it's a bridge. But our plan probably isn't to refi. It's to sell. It's 100 unit. It's a good C, but it's still a C. We're kind of wanting to edge up into B class if we can.
And so it's just a great opportunity to kind of hit the market right where it needs to be hit. So we're excited right now. We just got to hold it so we don't have the short-term capital gains. We want to get over that 12-month mark.
Yeah. Yeah, of course. So you just explained a strategy in the business that I want to go into detail, and I want listeners to hear this strategy. So there's a lot of strategies to buying and executing a multifamily. One is the long-term holders, the ones that want to go 10 years. The other one that's very popular in the syndication is 5 years. Buy, create value, refinance, get your equity out, stay with the deal. Your strategy was proof of concept. You said, we're going to show you guys that through strong management, being relentless, we could get these classic units $150 up, not spending much in the units, executing repairs. I'm pretty sure there was a lot of repairs when you got that. And then getting those repairs done, keeping the tenants happy. Some of these tenants, they'll pay the bump up, but just take care of their stuff. Fix my AC, put me a new AC unit, fix the leak. That's what they want. They don't want to move. So that's something that we see a lot of the visit. And then you said, let me create the business for somebody else to see that they could actually do this. Here's 20 units. This is what we did with 20 units. You could do the same with the remaining units. This is the value we created. Buy this from us. I love that. That's a flipper in the multifamily. I see it a lot. It's very popular. I buy properties from investors who do that because it's true. Now I'm not second guessing. I'm not second guessing if I'm going to be able to get the 80% of those units up in rent. You just did it for me. Proof of concept. Now I feel more comfortable paying an extra couple bucks for that concept that you already proved to me. So I get what you're doing. I like that. For those investors, because there's something that happens in the business a lot, and I say this out of my own experiences, and I hear a lot of other syndicators that are friends of mine, and we talk about it. Not everyone has the luxury when you're full-time in the business to sit back and wait 5 years to get a big payday. Sometimes you want to double up and start doubling up your equity and your money. So you want to do these flips every 2 years or every year and a half. A lot of investors are like, oh, I got to wait 5 years to get that big payday. No, you can actually get that payday with that concept of yours. Reinvest that money in a 1031. You do a couple of those a year, you're balling, man. You're making good money. So I get that business model. I like it. I do like it. Ismael, is there a deal, that Augusta deal? So you plan to go on the market in this Augusta deal soon?
I'm sorry, say again?
You plan to go on the market soon?
Well, we got to wait right now. 6 months in, we got to wait.
Oh yeah, you got
another
rush.
6 months so we can get out of the short-term capital gains. But yeah, we obviously the bridge has a little cost. If you get under, it was a 2+1, a 2-year bridge with a 1-year option. So we're going to pay a little bit, but we're going to more than make it up by just the number, the sheer price point. I think it's exciting to be able to do that. And I think the most important thing, and you mentioned it, they didn't have a functioning laundry in that community. I don't know. We were thinking, and I don't know how some operators are able to, keep things like that. It was a little bit depressing it's an opportunity certainly, but for tenants, I'm like, geez, no wonder the rents are so low. They're not really taking care of their people. And I mean, we've had comments recently that people were so excited with just a laundry room, they had to go 2 miles down the road and pay twice as much to get their laundry done. So there's a 100-unit facility without a laundry, 100-unit apartment without a laundry facility. And it's like, how can you do that? And by adding that laundry facility, we're actually adding income. It's the crazy part, right? It's like, so we're providing a service, we're improving tenants' lives, the way that they live. These are their homes. And yet we're able to, also turn these around and make some income, because I think those are the best ways when you have a win-win situation. Nobody wants to be a slumlord. At least I don't.
No, definitely not. And to say in the Class C sector, there is a lot of opportunities like that. The business is competitive. There's no questioning that. But those niches and those things you just mentioned, I see them all the time. There's a lot of opportunities for just someone to come in and just clean things up, do the right thing for the tenants, and you will get that value back. Also, like we mentioned, there's a lot of owners that they got their equity out, they're ready to go, they're tired. sometimes this business takes a toll on you, especially for the self-managing owners. I see that a lot. Self-managing, they've been self-managing 100, 200 units between them and their family, and they get tired, and they'll let somebody else come in with fresh energy and money to spruce these things up. So that's how you saw that opportunity. Now, Ismael, I want you to share an experience. So, we all talk about great deals and experience, but share with us an experience that was very difficult for you, and it was a lesson that you learned in real estate that you had to resolve it, and how you resolved the issue. So we can learn from mistakes and how you resolved it.
Yeah, no, good question. I tell you that this one sticks with me for a long time. This is right around that 2005 when I really started to get
just
involved.
That number, I'm like,
Yeah, when I started getting involved with in my case, it was duplexes and triplexes. For most people, that sounds like multifamily. We know that anything 5+ is considered multi, but for me, that was a step up from home. And so we were looking at this property. This was in San Antonio. I had just gotten back from overseas. They'd given me a little bit of time off, from being a year overseas. And I'm like, okay, I got money in my pocket. I want to invest. This is it. I got my window of time to do it. And I was in such a rush. I knew the market. San Antonio's a great market. It doesn't go up and down like some markets, but it's a steady incline. And I like that. People want that stable income and not some of the madness you can get in other markets that can jump and a lot. And so I looked at the market. I liked it. I said, okay, this is where I want to buy. But where I made my mistake was, because I had this window of time, is I rushed my due diligence, and we made this rough error with the due diligence. This was a property. It was a almost 3/4 of an acre lot, and it had a single family home on it, and it had a 3.2 trailer on it. It was on a pad. It was not like, what you would think is some, mobile home, rough looking. It was just it almost looked like a manufactured home because it had the skirts. But in my mind, I was looking at the numbers and going, man, this pencil's beautiful, and I don't remember what the numbers were, but it made all the sense in the world.
Yeah, cash flow popping up everywhere.
Yeah, so it was like, okay, this is a done deal. Where I made my mistake was the property had a septic system. And so I didn't get a separate septic inspection. We did a regular inspection, and it was checked off. This is a great condition, but the septic was not. It was almost full. They hadn't drained it, and it essentially it failed because you had too much going into that system. Well, this was about maybe 2-3 months after we bought it. It wasn't even that long. I didn't even get a chance to cash flow, and it fails. And we're like, okay, well, we got to get this thing fixed. Okay, I didn't expect it, but we got to get fixed. Well, here's the second problem. The city that we were in was no longer allowing that septic system in that area. They wanted a particular septic system, which is an aerobic system, because it's a little bit of an incline. So they didn't want, you couldn't put a normal septic in there. You just couldn't do, whole empty it. No, it had to be a separate system. And that system requires you to have, some separation between your residence and where the basically the sprinklers of the septic system push out the water, the treated but sewage water that rolls downhill a little bit. So guess what? I couldn't have that 3.2 manufactured home or mobile home. I couldn't have it there anymore. I had to get rid of it. So now I'm sitting with an empty mobile home because, of course, at that point I had to do something with it. So we emptied it out, couldn't get it fixed. So what do we do? So yeah, essentially what our solution was, I'm starting to get work, having to go back to work. What we had to do is we had to basically trade someone to install an aerobic septic system on the property in exchange for removing the mobile home part, the mobile home, because I don't have a trailer. That's not me. I'm like, what the hell am I going to use with this damn trailer that I can't even rent anymore?
So you traded the trailer for the
aerobic system and basically for them to move it out. That was actually
a good idea, though.
It was not a bad idea. Now my cash flow went out the window. Most years I was just under black, because it was a great area and it was surging, and so that single family home kept it kind of going. And honestly, in that time, it was not an issue of needing a lot of money because I'm in the military, I'm an officer, so it wasn't that bad that I couldn't sustain it, and it was great for taxes because I was always showing a loss that I would recoup. But in essence, I just kind of stayed right above water until I sold it. It sold well. I recovered a little bit then, but still, it was just one of those situations. And so the lesson learned for me is, when you get into, first of all, rushing is never a good idea when you're trying to do something you haven't done before. And that was kind of new to me, having to, go in and look at a property with a septic system versus a normal, city water setup. And so we rushed that, we jacked it up, I paid the price. And so now whenever we get into a situation that I'm not comfortable with, I just know automatically, okay, I got to pause, because this is where the errors happen and where you can really lose money when you're going in blind. I'm not saying don't take risks. I'm saying do risk mitigation. And that means you pause and you educate yourself and you ask the right questions. And, if the deal is not meant for you, don't do it, because if you could make that mistake. So I say that's my biggest story that I've learned.
I'll think that also I see that mistake I've made a very similar mistake to yours, not doing an inspection on not sticking a camera down a single family home and not inspecting the plumbing, and find out that the cast iron is all rotten. So, down here in South Florida, cast iron is not, there's too much water in the soil of Florida. So you got to always stick cameras when you're buying single families down here or any property. The cast iron goes very quickly. And I made that similar mistake. I didn't inspect the pipes on the ground, and it cost me $40,000. It was a high-end property. And but I had to give a credit at the end of the sale. Still made a profit, but that hurt. That hurt because I remodeled that whole house. I would have fixed that myself. But so I get that. So the lesson of the story is you got to spend some money doing inspections too. Yeah, you got to, but I do agree. Sometimes you got to slow down. You're in a hurry. The deal's happening fast. You're getting pressure from everyone. Your inspection period is shrinking. So you start to make certain decisions. So thanks for sharing that one. Ismael, man, it was a pleasure talking to you. You gave us a lot of education, a lot of tips in the business, and I love what you're doing over there in Augusta and what you're doing for the military, and you're educating in your culture, and that's what we need. We need more educationists. I am a true believer that our business should be at some day in public schools. They should teach cash flow. They should teach multifamilies, investing in real estate. It doesn't have to be multifamilies. It could be just the business in general should be taught very early in school, instead of people finding out the hard way as they get older. Hopefully one day it will be a curriculum. Ismael, how can a listener get in touch with you and learn more about you and what you're doing in your business?
Yeah, the easiest way is through my website, www.mirealestate.us. mirealestate.us, and from there, all my social media links and everything is there, and happy to entertain any questions from any listeners.
And where can they find your book?
So the book is on Amazon. If you type Bluff and you just put my name, Bluff Reyes, BLUF Reyes, it'll pop up. We get a lot of people that are reading it. It was not meant to be like a thing that made money, but I'm still getting people to buy it. So that's always a very good sign. I'm excited because it was actually a book that made Amazon's list for it wasn't real estate. It was some education. I can't remember the actual category, awesome. But it had to do with education versus, how to be a millionaire in real estate or something like that, that's where awesome. It's like, okay, that's just a pitch book. So I was excited about that. And yeah, man, it's just good to be able to pass the word and hope some of these younger folks, continue to get, the right guidance from people like yourselves, man. Just getting them to take those right actions, because time is short, and you're wasting time with single family. I tell them it's a good start, but once you get going, figure out how to transition, because you have X amount of time to do a deal. You can do a 1 unit, or you can do 100 units, and it takes roughly the same amount of time. And actually, there's more competition on a single family because everybody wants to buy one. So it's even harder to find a deal.
I agree. Ismael, man, thank you for your time. I'm glad that we did this podcast, and I'm pretty sure there's going to be some people hitting you up. And thank you. I'll see you around.
Thank you. Take care, everyone.
All right, man.